Your county sent you a bill this year. You paid it. You didn't question it. You assumed it was correct. What if I told you that bill was wrong, not because of a math error, but because your county is counting on you not knowing about 7 legal exemptions that could slash that number significantly? These exemptions are sitting on your county's website right now. They have been there for years. Some of them have been there for decades. And the county is not going to call you. They are not going to send you a reminder. They are not going to knock on your door and explain that you qualify, because every dollar you overpay is a dollar that funds their budget. I have spent 15 years analyzing local tax codes, county assessment records, and exemption databases across this country, and the pattern I keep seeing makes me angry. Seniors who worked their entire lives, paid off their homes, did everything right, are systematically overpaying property taxes simply because nobody handed them this checklist. Today, I am handing you the checklist. 7 exemptions. Most seniors qualify for at least 3 of them. Almost nobody claims all 7. By the end of this video, you will know exactly which ones apply to you and exactly how to claim them. Quick but important note before we go further. Exemption names, amounts, and eligibility rules vary by state and county. What I am giving you today is the master framework, the 7 categories that exist in some form across most of the United States. Your job after this video is to go to your county assessor's website. Just search your county name plus the words property tax exemptions and match what you find there against this list. Everything I am about to show you is real, legal, and already funded. You just have to apply. Exemption number 1. The Homestead Exemption. This is the foundation. If your home is your primary residence, meaning you live there, it is not a rental. It is not a vacation property. Most states allow you to reduce the taxable assessed value of that home just for living in it. Here is how it works. Your county assesses your home at a certain value. Let's say $300,000. Without a homestead exemption, your entire $300,000 is taxable. With a homestead exemption, depending on your state, that taxable value might drop to $250,000 or even lower. Your tax rate gets applied to the reduced number, not the full value. The savings vary. In some counties, it is a few $100s a year. In others, it is over $1,000. But here is what matters. You file for this once, and in most places, it stays on your record automatically every year after that. One form. Permanent savings. The shocking part. The American Farm Bureau and multiple county assessor studies have found that in some counties, up to 40% of eligible homeowners have never filed for this exemption. 40%. If you are not 100% certain you have filed for homestead in your county, stop this video and check right now. I will be here when you get back. And if you recently moved, pay attention. The homestead exemption does not follow you. If you sold your old home and bought a new one in the last few years, you need to refile. The exemption is tied to the property, not to you as a person. Exemption number 2. The senior exemption. In most states, once you reach a certain age, usually 65, though some counties start at 62, you qualify for an additional reduction on top of your homestead exemption. Think of it like a loyalty bonus from your local government for being a long-term homeowner and community member, except nobody sends you the bonus automatically. You have to walk in and ask for it. Here is where it gets frustrating. The senior exemption in most counties requires a separate application from your homestead exemption. They are 2 different forms, sometimes 2 different departments. And unlike homestead, which you usually file once, senior exemptions in many counties require renewal, sometimes annually, sometimes every few years. If you turned 65 2 years ago, qualified, filed the form, and assumed it renewed automatically, call your assessor's office and verify. I have seen cases where seniors were quietly dropped from the senior exemption rolls because they missed a renewal deadline nobody reminded them about. And here is the other piece. Some counties offer enhanced senior exemptions with even larger reductions for homeowners, over 70 or over 75. If you passed one of those thresholds and never updated your application, you may be getting a smaller exemption than you are entitled to. Exemption number 3. Veteran and Disabled Veteran Exemptions. If you served in the United States military, or if your spouse served, there is a real possibility you are entitled to a property tax reduction that could be among the largest single exemptions available to you, and you have never claimed it. Most states offer some form of property tax relief for veterans. For veterans with a service-connected disability, rated by the VA, many states escalate that relief significantly based on your disability rating. Here is what most people do not know. You do not need a 100% disability rating to qualify for partial relief in most states. A 50% rating, a 30% rating, even a 10% rating may qualify you for some level of reduction depending on where you live. And for surviving spouses of veterans, this is critical. Many states extend the veteran property tax exemption to the widow or widower of a qualifying veteran, even if the surviving spouse never served. This exemption is commonly missed during an already difficult time. which is exactly why I am telling you about it now, rather than hoping you figure it out later. Your county VA office or county assessor can walk you through the exact documentation needed. Typically, you need your DD-214, your VA disability rating letter, if applicable, and proof of property ownership. The paperwork is straightforward. The savings can be enormous. Exemption number 4. Circuit breaker programs. This one has the most unusual name and possibly the most important function of anything on this list for seniors. Living on fixed incomes, here is the concept. Your property tax bill should not consume an unreasonable percentage of your income. That is the philosophy behind circuit breaker programs. When your tax burden gets too heavy relative to what you earn, the state steps in and either caps your bill, reduces it, or refunds a portion of what you already paid. The threshold varies by state. In some places, the circuit breaker kicks in when property taxes exceed 4% of your household income. In others, it is closer to 6%. But consider what that means for a retired couple living on Social Security and a modest pension. If your income is $24,000 and your property tax bill is $3,200, you are sending over 13% of your annual income to the county just to stay in the home you already own. A circuit breaker program in your state could dramatically reduce or refund a significant portion of that bill. Circuit breaker programs are often administered through the state income tax system rather than the county assessor's office, which is part of why they are so widely missed. You may need to file a specific form with your state income tax return to claim the refund. Your tax preparer should know about this, but many do not. Ask specifically by name: circuit breaker, property tax credit. Exemption number 5. Property tax deferral. This is the one I told you about at the beginning. The one that has genuinely changed lives for seniors who felt trapped in their homes by a tax bill they could no longer comfortably afford. Here is the scenario this exemption was designed for. You are 72 years old. You own your home, free and clear. Your home is worth $400,000, but your monthly income is Social Security plus a small pension, maybe $2,800 a month total. And your county just sent you a property tax bill for $6,000. That is over $500 a month. That is almost 20% of your monthly income going to taxes on a house you already own, outright. In many states, a property tax deferral program allows you to stop paying that bill right now and instead have it accumulate as a low-interest lien against a home, to be paid when the home is eventually sold or transferred. You are not erasing the tax, you are deferring it. The equity in your home covers it eventually, but you keep that cash in your pocket right now, when you need it, while you are still living in the home you love. For seniors who are equity-rich but cash-poor, this program can mean the difference between staying in your home and being forced to sell it. Most states that offer deferral programs require you to be above a certain age, usually 65, meet an income threshold, have the home as your primary residence, and have no existing delinquent taxes. Interest rates on the deferred balance are typically far lower than commercial loan rates. Some states charge no interest at all. This is not widely advertised because it does not benefit the county's short-term cash flow. Ask for it by name. Property Tax Deferral Program. If your county does not have one, ask if your state administers a statewide version. Exemption number 6. Surviving Spouse Exemptions. I need you to pay very close attention to this one, not just for yourself, but for every widow or widower you know. When a spouse passes away and they were receiving property tax exemptions, a senior exemption, a veteran exemption, a disability exemption, those benefits do not automatically transfer to the surviving spouse. And in many counties, if the surviving spouse does not file the right paperwork within a specific window of time after the death, those benefits disappear permanently. Here is how this plays out in real life. A man passes away in February. He was receiving a veteran's exemption that reduced the couple's property tax bill by $1,800 a year. His wife is grieving, managing the funeral, dealing with accounts, managing legal paperwork. Property tax exemption renewal is the last thing on her mind. 6 months later, she gets the next property tax bill. It is $1,800 higher than it was before. She calls the county to find out why. They tell her the veteran's exemption expired because she missed the reapplication window. And in many counties, there is no retroactive remedy. That $1,800 is gone every year for as long as she owns that home. If you are a surviving spouse, or if you have a parent or family member who recently lost a spouse, this call needs to happen this week, not next month, not after the estate is settled. This week, ask the assessor's office specifically, what exemptions was my spouse receiving? What is the deadline to refile? And what documentation do I need? And if you have been a surviving spouse for more than a few years and never checked this call anyway, some counties allow retroactive credit for missed exemptions. You may be able to recover a portion of what you overpaid. It is worth one phone call to find out. Exemption number 7. The assessment freeze. This one has become increasingly critical over the last 4 years as home values across most of the country have surged dramatically. Here is the problem. When your home's market value goes up, your county reassesses it at the higher value. Your property tax rate stays the same, but it is now being applied to a much larger number. Result: your tax bill goes up even though you did nothing, bought nothing, earned nothing. Your house just sat there and appreciated. For a senior on a fixed income who bought their home 25 years ago and has no intention of selling, a paper increase in home value does absolutely nothing for their monthly cash flow, but it does increase their property tax bill, which is exactly backwards from what should happen to someone living on a fixed retirement income. Many states have responded to this problem with what is called an assessment freeze, sometimes called a senior valuation freeze or a property value freeze. Once you qualify and enroll, the county agrees to stop increasing the assessed value of your home for property tax purposes. The market value can climb all at once. Your taxable value stays locked. Eligibility typically requires you to be 65 or older, meet an income limit, have the home as your primary residence, and have lived there for a minimum number of years, often 5 to 10. Some states also require you to have already been receiving a homestead exemption. If you live in a market where home values have climbed significantly in the last few years and you are 65 or older, this exemption could represent the largest ongoing annual savings of anything on this list, and it compounds because every year your home would have been reassessed higher is a year you are now protected from. Now here is the number I want you to sit with. These exemptions do not just exist in isolation, they stack. A senior homeowner who qualifies for homestead, senior, veteran, and assessment freeze exemptions simultaneously and files for all of them can see combined annual savings of several $1,000s. Every single year, over 10 years, at even a modest combined savings of $2,000 per year. That is $20,000 that stays in your family instead of going to the county. That is a car. That is a year of care. That is a gift to your grandchildren. That is your money, and the only reason you are not keeping it is because nobody gave you this list. And I want to be direct about something. The county assessor's office is not your adversary. Most of the people working there will genuinely help you find every exemption you qualify for if you walk in and ask. The problem is not malice. The problem is passivity. The system is designed so that if you do nothing, nothing changes. You have to make the first move. Here is your action plan. Step 1. Search your county assessor's website for all available exemptions and identify which of these 7 appear. Step 2. Pull your most recent property tax bill and confirm which exemptions you are currently receiving. Step 3. Identify every exemption you qualify for that you are not currently receiving. Step 4. Gather your documentation, proof of age, proof of residence, military records if applicable, income documentation for income-based programs. Step 5. File every application your county allows simultaneously. Step 6. Set a calendar reminder to check renewal deadlines for each exemption annually. Step 7. Call your county assessor and ask one final question. Is there any other exemption available to a homeowner in my situation that I have not mentioned? Let them surprise you. If this video gave you information you did not have before, hit subscribe. We do not do vague clickbait here. We do not do 10 things your accountant probably knows, but we read 3 of them back to you. We open the actual tax code, we explain exactly what it says, and we hand you the specific steps to use it. Subscribe and turn on notifications so you catch everyone. And before you close this tab, do one thing right now. Text this video to one person you know who is over 65 and owns their home. Not because I need the views, because there is a real chance that person has never heard of one of these 7 exemptions. And one text message from you could save their family thousands of dollars. Send it now. I will see you in the next one.